All right, let's get over some options plays for Bed Bath and Beyond. So you want to play options. Implied volatility on the options is pretty crazy. We take a look at the options chain. Um, they're adding strikes all over the place. But for something at the money, something like a $5, we're just going to check the implied volatility 600%. Crazy, crazy stuff. Now remember, guys, when implied volatility is this high, it means the premiums for these contracts are going to be pretty expensive because a lot of people are buying them. There's a lot of open interest, 14,000, and basically people are paying a high premium to get into call options as well as put options. A lot of people are bearish as well, which they have a right to do because a lot of this movement is pretty crazy. Eventually, it's going to come down, but either way, buying calls, buying puts, it's going to be expensive because a lot of people are pouring their money into this stock and the stock options. So let's go over to an options play. January 13th, pretty much over. So we're going to be heading into January 20th. Now, an options play that we can do would be if you are, let's say, bearish, you want to do a call credit spread. Because as I mentioned earlier, buying calls, buying puts, they're very expensive, and you do need a huge move in order to make money on these options. But if it does have that move, you're going to make a lot of money. But that is pretty risky. So we're going to be doing what we call a call credit spread, which is a bearish position. So for example, this is just an example on how to create a call credit spread. First, we're going to be buying our first leg. So for example, we will do the $12 strike here. Let's do a $15 strike. We're going to be buying the 15, selling the, let's say, $11 strike. We're going to receive a credit of around $22, putting up a collateral of $400. So basically, we're going to be winning on this trade if Bed Bath & Beyond only moves slightly up, goes flat, or, of course, if Bed Bath & Beyond tanks and falls down. Because as long as Bed Bath & Beyond stays below our lowest strike, which is $11 per share, then we're going to be making our full profit. Now, we're not going to be making a ton of money, but we are going to be making about, I would say, 5% in just 1 week. And 5% a week is actually a really great return. And this is a pretty safe option strategy, especially if you're bearish, because you have a lot of wiggle room. The stock has to pretty much double in order for you to start losing money. Because as we said earlier, it's a call credit spread, $11 strike. As long as it stays under $11 per share by next week, January 20th, we're going to be making our full profit, which is $22 per contract you sell. You can sell multiple of these contracts depending on how big your account size is. So you can also do the same strategy if you're bullish. You don't want to buy calls, as you mentioned earlier. You're going to be paying a lot of money for these expensive call options. So let's say you think the stock is going to stay flat or go up, and you want a position. So you could do something like a $4 strike. We're going to be selling this one and then buying in out of the money strike, the $3 one. So as you can see here, we're going to be making $50 of credit as long as Bed Bath & Beyond stays above $4 per share by next week. And you're basically, okay, for this option strategy, you're going to be doubling your money because it's pretty close to this current stock price of $5.30 per share. But if you're bullish, this is a position you want to enter in if you don't want too much risk, because you're going to be doubling your money. You're putting up $100 of collateral, and you're saving credit of $50. So that's going to be a 50% return in just 1 week. So if you're bullish or you're neutral in this stock, you want to do a put credit spread. And this is just an example using buying the $3 strike and selling the $4 strike. That would yield you a pretty good return. And of course, you could adjust these strikes to whatever you want. But the reason why we're doing a credit spread and not just buying the call option outright is because we're capitalizing as an option seller on the high premium, because we're saving a credit instead of paying for the option. So this is really going to help us capitalize on the inflated premium, and it's really going to be how we win on these options trades and have a higher chance of probability of winning.